Hello, everyone. I want to welcome you all even to this class, this particular moment. My name is Dr. Obafemi Oyewumi, and today we'll be looking at taxation. And the topic before us is taxation of investment income. Taxation of investment income. Just give me a few seconds. Let me share my screen for all to see. Just a moment, please. Just a moment. All right, so I believe we are seeing my screen right now. So once again, thank you very much. For those that have subscribed already to my YouTube channel, you're welcome back. And for those who are yet to do, please, I want to encourage you to just subscribe, share, like, the topics and the understanding you have here so that I'll be able to comment on them, so that I'll be able to get to know more. Of course, also be able to see any other lectures that we drop in, here and the articles of what you have to learn there. So today we're looking at taxation, and so once again, it's taxation of investment income. Now let's look at the learning objectives. Number one is to understand the major categories of investment incomes, and then to appreciate the concept of investment income, types of investment incomes, and taxation of investment income. So let's move ahead even right now as we look at classifications. Now, when we talk about classification of incomes, there are two broad, categories of incomes. Two broad categories. The first one is called earned income. Earned income. So, what is earned income? Earned income is cash or any money received in exchange for work or service personally rendered, including employment and self-employment. So what does this mean? It means that it's an assignment or a work that you do personally, you carry out, you are involved, you are involved personally, physically, and whatever it is that you get as a reward, in form of cash or in form of, maybe credit to your account or whichever way it's coming, okay, the one that you receive in exchange of for work or service that you rendered personally. So it comes from of employment and self-employment. So we have salaries, we have wages, we have commissions as well. Now let's look at unearned income. Unearned income is cash or other benefits that people receive without being actively engaged or required to perform a work or service. So in this case, now you are not actively engaged in this kind of assignment or this type of activity. You're not physically engaged. These are incomes derived from other sources other than employment, business, or reward for services rendered. So it is not a service, it's not something that you're physically or you are involved in. So it is other than the employment or business. So we have rental incomes. Examples now, we have rental incomes, we have interest on deposit, we have royalty, we have portfolio investment incomes, we have earnings from trademarks, we have dividend, income as well. So these are different types of unearned or passive incomes that people have per time when they begin to invest their money into one or two things that will fetch them this type of income. So we have been able to look at the two broad base categories now. So let's look at, because we're talking about investment incomes today. So let's look at the word investment first and foremost, because we've talked about so that we have an understanding of what we're looking at this particular moment. Investment. What is investment? Ordinarily, investment is setting up a business or putting money aside to buy financial instruments, properties, assets, new stocks, or machines to take advantage of future price appreciation. Future price appreciation, okay, that will come in form of profit, returns, interest, or gains in the future. So that is investment, setting money aside. You're trying to invest, put money aside to, to start a new business, for example, to set up a business or to buy some financial instrument, to buy properties, to buy assets, to buy new stocks, and then to buy machines in order for you to take advantage of future price appreciation. Okay, that is talking about investment. That's talking about investment. So it means allocating financial resources in the form of capital to generate an income, profit, or gains. So when you allocate financial resources in form of capital, your own capital now, in order for you to generate income in the future, that is when that is investment. You make profit and you make gains. That is investment. All right. The basic intention of investing money is to grow one's financial net worth over a period of time. So it means that you are investing money, okay, for a future gain, a future profit. That means it's not as if you do the business now to expect it now. No, you're setting up a business, you're investing money, in some assets so that you're able to gain, capital appreciation, you're able to gain, dividend or gain profit, or gains that will come in, later on in the future, ahead of you. All right, so that talks about investment. Let's look at types of investment, okay, that we can probably be looking at stocks, okay, when you become a shareholder, of a particular company. Okay, when you part own the shares of a particular company, then you become a shareholder. So you're investing in shares, okay, shares of other entities. What about bonds? These are financial, debt instruments. Okay, you are this time around the company or maybe the institution is owing you. Okay, you have invested money in debt instrument. What about the second one, the third one? Funds managed by investment managers, pooled funds. So these are types of windows that you can actually invest in, your money in. Talking about commodities, natural metals, oil, natural commodities. Okay, talking about gold. So these are instruments that you can actually use and invest your money into. Now let's look at investment incomes. Now, investment incomes are incomes received primarily from investment decisions. Incomes received primarily from investment decisions, and they include decisions on purchase of shares, property for letting purposes, fixed deposit, or other interest yielding account. These are the ways to capture investment incomes. Okay, we're talking about investment incomes that you receive, that you derive primarily for investment decisions that you have made over time. And this decision, of course, will include, for example, you want to buy shares, like we said earlier on, buy shares in a particular company of a particular company, and then property that you invested money in order for you to begin to let them out so that they'll be able to have people that will come and use it and then pay you fixed deposit, other high yielding, account. Investment income is money earned or derived from investment. So money earned or derived, let me add this one, derivable, from investment income. So that talks about investment incomes. Okay, this comes in form of interest earned on savings account, interest payment, dividends, capital gains realized on the disposal of asset, stocks, or other assets. Okay, so when we talk, these are the ways to describe investment incomes. Investment incomes refers solely to the financial gains received as a result of capital outlay on various investment instruments and windows, so that an asset as well. So these are the way to describe investment incomes. All right. So let's go ahead and talk about types of investment incomes. We have different types of investment income. Now we're looking at the first one, rental income. Rental income. So when we talk about rental income, what are we referring to? This is the income arising from the use or occupation of any property by someone other than the owner and is chargeable to tax. So income arising from the use of a particular property, occupation of a particular property, okay, by someone else other than the owner and is chargeable to tax. Other than the owner, because in most cases, when you occupy, your property, you may not have, you don't need to pay, income, for that, or pay rent for that. Okay, so rental income is generally deemed to accrue to the recipient on daily basis over the period of time covered by the payment or by the tenancy. All right. So when you incur, when you receive money, peradventure maybe even in advance, it is deemed to be accruing on daily basis. Daily basis. Okay. And by so doing, monthly, quarterly, half annually, or by annual, and then at the end of the day, you now say, okay, this is what you have paid for. So it's assumed that you accrue on you to spread over the number of years that you are paid for. Rent received in advance is to be spread over the period of rent, provided the period is not more than 5 years. So if it is more than 5 years, whatever it is that have been paid for will still be spread to cover 5 years. That's what I mean for tax purposes. It will still be used to cover for 5 years. Thus, for tax purposes, the gains or profits arising from rent of properties are taxed ascertained by deducting only those expenses that were directly incurred to earn the income. Okay, let's look at expenses that are liable when you are computing, when you want to derive, taxes, okay, coming from investment in properties, for example. Allowable rental expenses in computing, okay, the gain and profit from rental income for tax purposes. The following expenses are allowable deductions. So let's look at them. Tenement rates or land use charge. Tenement rates or land use charge. These are statutory payment they have to make to the government because one way or another, yes, they gave you the consent for you to make use of the land. Cost of collecting rent. Maybe you have to pay fees to caretaker, estate agent, legal representative, professional fees, and all of that. Cost of advertising for tenant is also part of it. Any expenses incurred for repairs and maintenance of the building, repairs and maintenance of the building, not repairs and maintenance of the personal property of the landlord. Okay, bad debt incurred peradventure. Maybe any of the debts have become, maybe lost. All right, and they are recoverable. Interest on money borrowed or employed in acquiring or innovating the property. Commission paid to agents or caretakers. Okay, insurance premium paid to paid on the property, water rate. These are the expenses that are allowed for the purpose of determining how your tax to be computed. Let's look at those ones that are not allowed. Now we have any expenses not incurred to earn the rental income. So either other expenses that are coming that are not, incurred, but not for the purpose of earning, the rental income, it should be disallowed. Any expenditures of capital nature, if you are still investing or you are building more, sorry, you cannot say you want to expense it. All right, depreciation of the building, okay, appropriation of profit, including income tax, drawings, and reserve. This will not be taken as part of expenses that are liable for the purpose of tax. All right, so let's go ahead to talk about another type of income. Okay, another type of income, the investment income. Here we're talking about interest. Interest. The income from any interest on money lent by an individual or an executor or a trustee outside Nigeria to a person in Nigeria, including person who is resident or present in Nigeria at the time of the loan, shall be deemed to be derived from Nigeria. So we're talking about interest on money given to an individual or given by an individual, whether the person is outside of the country, whatever, so long as the interest will be paid based on the relationship or contractual relationship between the person and the business, then such, an interest will be taken as derived from Nigeria. So there's a liability to payment in Nigeria, regardless of where the payment takes place, okay, or how whatever the payment is made, the interest accrues in Nigeria to a foreign company or person, regardless of what form of payment it takes, or whichever way the payment is made. All right. So once the liability to make the payment is coming here, then definitely coming from here, it means that it has to be subjected, to tax. Where an individual is resident in Nigeria, the interest accruing to him from any source outside Nigeria is liable to tax in Nigeria if such an amount of interest is brought into or received in Nigeria, subject to double taxation provisions, if applicable. So we're saying here that if interest is received from a company resident in Nigeria or interest that accrued, to somebody, okay, even based on the fact that, yes, the interest is from outside of Nigeria, but so long as it's brought into Nigeria, then it means that, that the money is taxable, okay, in Nigeria, okay? So let's move ahead and look at, interest that are exempted, from tax. Interest exempted from tax. Interest accruing to a person on a foreign currency domiciliary account. Interest accrued to a person on a foreign currency domiciliary account that would not be subjected to tax. Interest on any loan granted by a bank on or after 1st of January 1997 to a person engaged in agricultural trade or business, the fabrication of any local plant or machinery, and as working capital for any cottage industry established by the person under family economic advancement project or program. All right. So these are interests that will be exempted, from tax in this part of the world, the Nigeria. Okay. So let's look at dividends now. Let's look at dividends. Dividends is the share of company's profit to its shareholders. Okay, it's a share of the company's profit to its shareholders. That is dividend income. We're talking about dividend income now. The share of the profit, at the end of the year, companies will make profit and then they will now distribute the profit made as dividends to the owners of the share, those who owned, the company. That's what we're talking about here. So dividends is the share of the company's profit to its shareholders in proportion to their respective shareholders at the end of a financial year. That is dividend. For the purpose of tax, definitely we know that any dividend that's distributed, by a Nigerian company is grossed up. Why? Because withholding tax must have been deducted before it is paid. Whatever anybody receives in this part of the world, Nigeria, okay, the withholding tax must have been removed from it before it gets to the shareholder. So for the purpose of tax, that same thing must be grossed up. Okay, grossing up means that you're going to use the same rate of withholding tax that they use in calculating the withholding tax. That's what you're going to use to gross it up, bring it to 100%. Okay, that's means of grossing it up. So any dividend that can be proven, again, any dividend that can be proven to be earned from abroad and brought into Nigeria by a Nigerian resident in convertible currency and paid into any approved bank domiciliary's account in Nigeria is exempted from tax. So we're saying here that it's not every dividend that be subjected, to tax. If you can prove that this particular dividend is earned abroad and brought into Nigeria, okay, in foreign currency and lodged into a bank account approved by the government, okay, then you can say you are not going to pay, withholding tax on that. Why? Because before it gets out of that particular country, they must have, subjected it to withholding tax. All right. So let's look at the basis of assessment. Determining the year of assessment is critical. That's the truth. It's critical in the taxation of investment income. Take note of that. For the avoidance of doubt, the basis of assessment of dividend, interest, rent, and royalty is the preceding year basis, not on actual, the preceding year basis. So the interest, the dividend of the past year will be assessed with us for this year, preceding year basis. Okay, so that's the basis, and you must take note of that. Let's look at the concept of frank income, frank investment income. So when we talk about frank investment income, we're referring to dividend that has been received by a company after deduction of withholding tax at source. Such dividends is regarded as frank investment income. Frank investment income. So when dividends are subjected to tax at source, deducted, that's within that deducted at source before the net is paid to you, such investment income is taken as frank investment income. Such income is no longer subjected to further tax in the hands of the owner or the recipient company, because withholding tax must have been deducted, and the withholding tax so deducted will be taken as the final tax. Will be taken as the final, tax. The dividend will be excluded from the total profit of the company receiving the dividend before the computation of the company's income tax liability. Before arriving at the company's income tax liability, such an amount, will be excluded from the total profit of the company. Any dividend, please take note, any dividend that has not suffered withholding tax will not be regarded as frank investment income. So what does that mean? If you, maybe peradventure, maybe by omission or by anything, investment income has been paid to you, okay, and to a particular company, and that entity, the dividend so paid did not suffer any form of withholding tax element. So it means that the same, dividend will not be regarded as frank investment income, and as such, it will be subjected to tax under certain provision. Okay, so the onus for you to prove that yes, you collected so much after a particular amount of withholding tax be taken out of your dividends. Okay, so let's look at taxation. Let's look at, we're still talking about that's for investment under after the dividends. Okay, so let's look at royalty. Let's look at royalty. That's another type of investment income. Royalty is a payment to an owner for the use of developed. I use the word develop there. Okay, let's look at royalty. Is develop a tangible asset. So it's a payment to an owner for the use of developed intangible asset or natural property, including patents, copyrighted, works, franchises, or natural resources. So when you have access to a particular, maybe reserve somewhere, you have gotten a license, to maybe to carry out a particular, exploration in a particular well or somewhere, you can actually get royalty from such. Okay, so it's a payment to an owner for the use of developed intangible asset or natural property. That's what by natural property now, resources that you are gaining maybe for exploration of a particular, asset or exploration of a particular commodity, including patents, copyrighted works, franchises, or natural resources. A royalty payment is made to the legal owner of the property, patent, copyrighted work, or franchise by those who wish to make use of it to generate income, to generate revenue, or other such desirable activities. So how do you calculate royalty? It is just by multiplying the percentage of the revenue obtained, okay, and obtained from the from that particular source, multiplying it with the agreed rate, between you and the owner must have agreed. So this is the percentage that will come to me. So whatever amount comes to you will be a function of the interest, or rather the royalty value or a percentage that will come to you multiplied by the amount of money derived from that particular, the use of the asset. Okay. So now, however, we say here that, however, any foreign royalty that is brought to Nigeria from abroad in convertible currency and paid into an approved bank domiciliary account is exempted from tax. It's exempted from tax. That's what we're saying here. It's exempted from tax. That we are exempted from, tax. All right. So let's talk about now. Let's look at taxation of investment incomes. Taxation. Now we are something we are being able to cover the different types of investment incomes. So let's begin to talk about how would these incomes be, subjected to tax. I say as an opening, statement here. Taxation of investment is given preferential treatment in the form of withholding tax deduction at the point of payment, and that's what we've been saying, along the line. Okay, before you get your income, in most cases, they have already been taxed. So it is taken as a final tax that will be used to offset the eventual tax liability. Okay, so let's look at interest, for example. Interest received by a Nigerian company is liable to tax at the relevant CIT rates. Okay, relevant, but then it must suffer withholding tax. All right, suffer withholding tax. So interest on federal government bonds is also tax exempt up to this particular period, 31st December 2021. Okay, 31st December 2021. But then tax on interest earned by non-resident company is also liable to withholding tax of 10%, liable to 10% withholding tax, and is to be taken as the final, tax at the end of the day. So what we're saying here is that where every interest that will be subjected to CIT, that's for the company now. We're looking at the company now. Okay, that will be subjected to CIT will definitely have to suffer what is called withholding tax, and it's usually 10%. Okay, 10%. Now, rent received by a Nigerian company on Libya is also liable to tax. And what is the form of tax? Withholding tax of 10% as well. Withholding tax of 10% as well. Okay, what about royalties? In the same vein, too, royalties is also liable to tax. So we're saying that all these incomes are liable to tax. they have to be taxed. But then the tax rate, at the point of being paid is 10%. So 10% withholding tax, 10% withholding tax, which will be used to offset the final tax liability at the end of the day. Okay, let's look at dividend. Dividend received by Nigerian company are also taxable. So dividends received, by Nigerian, will be taxed. All right. Again, 10% withholding tax is also applicable, for this particular purpose. And of course, we know that it will, of course, be removed even before dividends is finally paid, to the beneficiary. Okay, so I will have an example that I want us to look at, at this particular point in time. We've actually come to an end of this. And of course, let's look at a particular example so that we're able to have a better understanding of what we are talking about. Let me reduce this so that we can see it clearly. Okay, so that we can see it clearly. Just pardon me. Let me go back. Okay, trying to reduce this as much as possible. So I believe we can still see. Okay, it's not unknown, so let me bring it down. So let me bring it down. Now, Mr. Azan Isaac rented out his two-wing duplex building located in Lekki, Lagos State, for 2 years on December 31, 2021, with the assistance of an estate agent. The tenancy, which was for 2 years, took effect from January 1, 2022. Look at this date. Okay, he left the apartment on that December 31, 2021, and then the thing took effect from the tenancy took effect from January 1, 2022, respectively. He made the following details available concerning his income and expenses for the relevant period. So you can see that the column here 2022, and then the column here 2023. Okay, rent received 4.5 million for the 2 years. Cost of repairs 420, 510. Okay, rate, water rate 182,000, and then 205,000 in 2023, and then and all like that. Agents commission, professional fees, insurance, caretakers charge, tenement rate. Okay, additional information, capital allowances agreed with relevant tax authorities for 2023 and 24 were 350,000 and 350,000 respectively. So for both years, 350,000. Cost of repairs comprised of the following: depreciation, repairs of tenants' bathroom, repairs of Mr. Isaac residence. Tenement rate includes tenement rate of 50,000 and 7,000 paid on a private residence of Mr. Isaac for 2022 and 2023 respectively. So we can see, the different, information given to, us right now for us to be able to compute the rental income accessible to tax for the relevant years. Rental income accessible to tax for the relevant years. Now, we've spoken about relevant on the basis, of assessment earlier on. I would say that first and foremost, you must know the basis period. I must know the year of assessment. Now, we said that it should be on preceding year basis. So that means that for 2022, okay, this will come into 2023 as 23 year of assessment, and then this will be 2024 year of assessment because we're talking about preceding year basis. All right. So for the purpose of solving, this, I will go back to another screen so that that will be sharing. Okay, I'll stop this and then I will go back to share another one for us to see. I want to use Excel to be able to solve this, okay, as much as possible. So just bear with me. I'll do that right away. Just bear. Okay. Now let me share the screen for the Excel. Now the same information has been repeated, here, and of course for the purpose of now the same information that we have here. Okay. Rent receipt. I've actually explained this before. So these are the things that we now have, here. So we want to solve this particular, illustration. Rent received, we know it. Okay, and then this is, of course, I've done this so that I'll be able to hasten the entire process. I'll be able to move as fast as possible. Okay, for the purpose of calculating what we have here. Now, rent received, the information is also provided on this side of the left side now of the screen. Rent received for this time around now is 4.5 million. Okay, and that's also coming here to 4.5 million naira. So that's what we have. So for 2023, we have assessment, and then 24 year assessment. Okay, cost of repairs. All right, so we have cost of repairs here, cost of repairs here. So now an information was given to us earlier about cost of repairs. So cost of repairs, comprised of this information. So we now want to know which of this information will apply in terms of getting us or enabling us to know the amount that will be deducted as a liable expense. So it's important that we take note of that particular aspect as well. Please, it's important that we take note of that as much as possible. So let's look at them. Let's look at the constituent items here. Now, number one, we said that cost of we include depreciation. Now the question is depreciation an liable expense? Concerning in this particular regard now, obviously it is not. What about repair of tenants' bathroom? Is it allowable? Okay, so these are the things I have to begin to think about and know those that are liable and those that are not liable. Repairs of Mr. Isaac's residence, that's some personal residence. Will it be taken as part of a liable expense or not? So you have to take note of this particular information. So let's go ahead now and look at what we have to just do. So let's go to the column that we have here. All right, so let me reduce it because so that I'll be able to have everything on the same page. Okay, I'll have everything on the same page. I will not be moving the whole screen up here and there. All right, so let me also remove this for the purpose of space. Okay, so cost of repairs. So we're saying here now that you have this as this figure. So what do? You remove those ones that are not allowable. Depreciation is not allowable. Okay, then as inside this residence too is not also allowable. So what do you now have at the end of the day? So it means that you're going to have, 149 that is allowable. So that's what you have. Okay, that's what you're going to have, there. All right. So let's go ahead as we also consider this. So we come to here is 510,000 and then deduct depreciation. Okay. And then also deduct what Mr. Isaacs, there. So you have what you have 194, thousand. So that's what you're going to have there as the amounts to be, taken. Then we have water rates. Water rates is what? So you just go pick the figure. Water rates allowed. So pick this as well. Then professional charges or agent's commission, 350 is also allowed. Okay, they earn plenty of money these days. So 550, done. Then you look at professional charges. And then all you have to do, just go ahead and pick your professional charges, maybe legal fees and all of that. Or, so insurance on the building. Again, you also have insurance that you're going to take as the entire figure, for that. So you have insurance, okay, at the entire figure we take it. Then caretaker's charge, of course, that's part of the expense that you have to incur in order for you to be able to gain, earn the income. Okay, so we talk about caretaker's charge that is 118,000, and then 125,000 is also going to be taken, there. So that's talking about, so far so good. What we're looking at, talking about expenses. Okay, so let's look at tenement rate. Tenement rate is 125,000 naira. And then we have an information given to us in the course of the so tenement rate includes tenement rate of 50,000 and 7,000 paid on the private residence of Mr. Isaac for 2022 and 2023. So what do? You have to deduct, from this 2022 now 50,000. So you get 75,000. Then you also arrive at 128,000. That's the amount paid for tenement rate. We're going to do tenement rate from the 70,000. You're going to deduct it from the amount. Now let's arrive at tenement for the building that has been rented out. Tenement rate for the building that has been rented out. So that's what you have been able to we've been able to arrive at. So let's add everything together, okay, to find out how much total expenses that will be removed from the income. Okay, so that's what we've been able to get. That's what we've been able to get even right now. Okay, as the total expenses that are allowable for the purpose of this particular transaction, okay, for the entire year for 2022 and 2023. So let's look at accessible rent. What you have to do is to deduct the rent receipt. So we're talking about the rent that are going to assess. Okay, that's what you now have. And then you're also going to copy the same figure and then you arrive at that. So then we're giving a background information too to say that capital allowances agree with the relevant tax authority for 2023 and 24 years, where 350 and 350, respectively. So we're going to come to capital allowance. Okay, so they're going to deduct 350,000, from that figure. That's what you have, 350,000, okay, for both years, 350,000. So what do you now going to, how do you arrive at chargeable income? Okay, that's the amount to charge to tax. So you're going to deduct 350 from the accessible rent. Okay, so that's what you have. And then you arrive at this figure now, 32.926. And then you're going to do the same thing, here. And then you arrive at we do the same thing. That's to say, you're copying from there, and that's what you have, 2.618. So that's the solution. That is the solution to the question given to us earlier on, okay, which has also been copied to this particular part of the Excel worksheet. So for Mr. Hassan, the IC, completion of rental income for 2023 and 2024 year of assessment, this is going to determine it. So this is accessible rent at the capital. After you do the capital allowance, then you now have your chargeable income. So this chargeable income, that is due to be taken or charged to tax based on the income of Mr. Isaac from his rent of his flat to his tenants. So, and that will bring us to the end of this particular class, at this particular point in time. I believe we have learned one or two things regarding taxation of investment income. Okay, it's important for us to read more to be able to learn more, as much as possible. So if I learned one or two things, I want to say thank you once again for joining this particular class. If you are yet to subscribe, please, why don't you just go ahead right now, subscribe to my YouTube channel, okay, like it, share this particular video, and as much as possible again, make necessary comments. I will go back, come back there, and then look at it, and I'll give you appropriate answers as much as possible to also afford you the opportunity for you to learn more, to know when another a video is dropped for your purpose, or for the purpose of your educational advancement. So thank you very much for joining. See you at another time. Bye for now. All right.